Hello and welcome to Chapter 1, which is on the regulatory framework. Now, this chapter is part of Section A of the F1 syllabus, and together with Chapter 2, they make up 10% of the marks in your exam. And the examiner is looking to test your remembering and understanding of these chapters. So as you'll see, there are some useful lists to be learned over the following few pages. Now, this chapter is really a background chapter, so we're going to start off by thinking about why financial statements need to be regulated, and then we're going to learn a bit more about the different sources of regulation. So let's start in section 1 then, which is called the need for regulation. Now, you might remember as part of your earlier studies, you will have learnt that a company is a separate legal entity. And the group of people who run the company are called the directors. So there we have 3 directors. However, the group of people that owns the company, here they are looking remarkably similar, are the shareholders. Now, with a big company, the shareholders will not be involved in actually running it, and therefore they are going to need information on a regular basis to help them make decisions which relate to their investment. And therefore what the directors do on an annual basis is they will prepare the financial statements for the shareholders, and the shareholders can look at those financial statements and make decisions regarding, for example, whether they're going to buy more shares or sell their existing shareholding. Now, if those financial statements were not regulated and the directors could produce them in any way they wanted to, they wouldn't really be very useful to the shareholders. And that is why we have accounting regulation. The objective is to ensure that the financial statements prepared by the directors give a fair presentation, which in the UK we often call a true and fair view. So you may be a bit more familiar with that term. Now, what we're looking for a true and fair view of is firstly the financial performance of the business, which primarily comes from the statement of profit or loss, and also the financial position of the business, which we can see, of course, in the statement of financial position. And we need those financial statements to provide the information that the providers of finance, such as the shareholders, or maybe lenders, such as the banks, need. So specifically, accounting regulation ensures 3 things. Firstly, there is guidance on producing information that is relevant to users. So these users, remember, are the shareholders and the lenders primarily, and they will use this information that is relevant to make economic decisions, such as whether to lend more money or whether to sell their shares. It also ensures that financial information is prepared in a consistent way. Firstly, for one company, on a year-to-year basis, so we're not chopping and changing the way in which we account for things. And also it's consistent between different companies. So for example, we might have an investor who's got a big pot of cash. They're trying to decide whether to invest in company A or company B. And when they're looking at the financial statements of those companies, they want to feel assured that they have been prepared in a consistent way. So these users will hopefully then be able to rely on this information to draw comparisons from consistency, and also, as we mentioned, to make economic decisions. Now, we're going to focus next on where does this regulation come from, and to be honest with you, accounts are influenced by a variety of different factors, and therefore, depending on which country we're in, we're going to be seeing slightly different sets of regulation. So let's take a look now then at the different sources of regulation. Now, the first source of accounting regulation we might have is the law. Two types of law in a country that might affect a set of financial statements. We have corporate and taxation law. And these different types of law will be set out in one of two ways. Firstly, we have something called code law, and this is where the legislation is based on a very detailed set of rules. And often the way in which we account for things is actually driven by tax law, driven by the government. The other type of law is common law, which is where law is based on cases that have acted out in court, and therefore we will have fewer detailed rules. And in countries where we have common law, it's likely that there will be minimal accounting requirements in the legal system. Instead, they'll be set by separate professional bodies. So for the purpose of your exam, make sure you learn the difference between these two types of law. Now, a piece of legislation in the UK that you may already be aware of is called the Companies Act. And this Companies Act applies to all companies, even the very smallest ones. And what it does is it sets out very prescriptive layouts for the financial statements. So, for example, the formats that they need to take. It also sets out disclosures, so information that must be given or included in the notes to the account. And the objective of the Companies Act is to ensure that financial statements give a true and fair view. Now, alongside the Companies Act, we also have our accounting standards. And companies in the UK will follow one of two different sets of accounting standards. Now, the ones that we are going to be learning about for the purpose of our CIMA studies are the International Financial Reporting Standards, which are shortened to IFRSs. And these are issued by a body called the International Accounting Standards Board, and we're going to learn a little bit more about them in just a few minutes. Now, in many countries, including the UK, it is just the biggest companies that follow these IFRSs. So in the UK, it's a requirement for all listed companies. Now, what about other companies in the UK, so smaller companies? Well, these will follow our own national accounting standards, which are issued by a different body, which is called the Financial Reporting Council, or the FRC. You see their name occasionally in the newspaper, so you might have heard of them. And they have written an accounting standard called FRS 102, which again you might have heard of. And this standard is based on a simplified version of IFRS, because the International Financial Reporting Standards are really written to suit the very biggest companies. So for slightly smaller companies, it is a slightly simplified approach. So as well as our accounting standards, other sources of regulation might come from stock exchanges. So this will apply to listed companies only. And we may also have regulations which come from other regulatory bodies, such as the European Union, for example.